I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. Over the past week, markets have been hit hard. President Trump shocked the global economy by announcing a sweeping new set of tariffs on Liberation Day. The tariff plan includes a 10% universal tariff and reciprocal rates rising as high as 54% against China. Europe and Japan are also seeing elevated rates, with the EU facing a 20% tariff and Japan 24%. This represents the largest tariff increase in around 100 years, reshaping both the US economy and global trade. If fully implemented and sustained, these tariffs could hit US GDP growth by 1.5% to 2%, acting as a heavy tax on US consumers. What's more, they could push US consumer inflation up by nearly 2%. Export-reliant economies will need to find new growth sources as exports to the US could be hit substantially. Equity markets have plummeted, resulting in higher volatility, while bond yields have also edged lower. The market reaction so far suggests that the current focus is on downside risks to growth, and these outweigh concerns about upside risks to inflation. We do expect market volatility to persist in the coming days and weeks. Our Signature CIO strategies have not been spared by the recent news flow. However, the year-to-date performance remains relatively stable thanks to our diversified investment approach, which has helped cushion the adverse impact. What does this mean for markets moving forward? We see two key developments likely to shape the macro and market outlook from here. First, the responses from countries hit with tariffs will be critical. We expect a mix of retaliatory measures and negotiations. Which trading partners are open to talks and how receptive the US administration is to engaging in these negotiations will be key. Some countries have already signaled their willingness to take the negotiation route. Second, we can't forget the broader context of Trump's policy agenda. His focus on tax cuts and deregulation is meant to support growth and may cushion some of the tariff-related drag. We acknowledge that tariffs on their own raise recession risks. However, on balance, we expect the Fed rate cuts starting in the second half of the year to provide support, helping the economy achieve a soft landing, especially if tariffs are unwound to some extent. In the coming weeks, we'll watch how trading partners react and negotiate, and how tariff risks weigh against the positive impact from likely tax cuts and deregulation efforts on US growth. In the meantime, we continue to emphasize the importance of maintaining a diversified portfolio, with a balanced equity allocation across regions and hedges such as gold to navigate the uncertainties ahead. Thank you for joining me for this monthly CIO Signature Strategy Update. I'll be back with more updates next month. Look forward to seeing you then.